we about to enter another global crisis, an economic meltdown of gargantuan proportions? Is the everything bubble about to pop? We'll find out in just over 10 minutes because it's time for Chico Crypto.
Because I want to reach in, rip out their heart, and eat it before they die.
Together, we can change the world with
Evil Corp.
The last time America had an economic crisis of these grand proportions was in 2008, the Great Recession, which followed in the wake of the Lehman Brothers bankruptcy. And the main reason for this economic failure was the turning of a blind eye to the financial sector's acute vulnerability to the potential bursting of the US housing and credit market bubbles, as it wasn't only the Lehman Brothers who went down. The crisis led to the failure or collapse of many of America's top financial institutions: Bear Stearns, Fannie Mae, Freddie Mac, the Lehman Brothers of course, and AIG. The culprit of the collapse was the bursting of the subprime mortgage market, defaults on high-risk housing loans, which led to a credit crunch in the global banking system. Yeah, this rippled globally. What America did had economic effects worldwide. In the year following the 2008 financial crisis, economic activity declined in 50% of countries across the globe. However, the US government made unprecedented moves to get the economic wheels turning once again. The government responded with a $700 billion bank bailout and a $787 billion fiscal stimulus package. Now, there are some people out there who will argue that the last time we had an economic crisis wasn't in 2008, but was only 2 years ago, the mini Rona recession of 2020, which only lasted for 2 months, from March to April of that year. Even from FED data from the United States Fed, we can see they consider that time in US history a recession. But compared with other recessions, this was the shortest one ever. As we can see, the next shortest one was in 1980, which lasted for 6 months. And on average, since World War II, the average length of a recession is 11 months. And that Rona recession probably would have fit the normal length if it would have been allowed to progress naturally, but it wasn't allowed to. The government took drastic measures, even more drastic than 2008, to prop up the economy, even though our financial institutions weren't in trouble. Beginning under then President Donald Trump and continuing with current President Joe Biden, Congress has approved some $4.5 trillion in total aid and stimulus package. This money printing stimulus is massive and isn't confined to just the US, it's global. Here are countries and their stimulus package as a percentage of GDP. Rona stimulus is blue and the 2008 stimulus is black. As you can see, the Rona stimulus bubble is much larger than what happened in 2008 for the world's biggest economies. And this has all been done while keeping interest rates historically low. As we can see from this chart, they have been basically kept at zero since March of 2020 for the US, meaning vast amounts of money have been loaned to borrowers and their ability to repay is in question. And those monies have been loaned at the very low interest rates, which do not nearly compensate the lenders for the borrower default risk. And the borrowers have been throwing this money into assets across the board. Stocks were at their highest levels. Before the Rona panic, global stock valuation was just under $90 trillion. Once the panic came, stocks hit a bottom of just above $60 trillion in March of 2020. By the end of December 2021, they were over $120 trillion. What about another asset, housing? Well, the median home price pre-pandemic was about $329,000. During the panic and recession, that median price fell to $322,000. Well, as of today, the median home price has surged to nearly $405,000. And expanding out the chart, you can see this is the fastest growth of US home prices in history. And of course, we know Bitcoin and crypto. Pre-pandemic, the total capitalization of the crypto markets was about $300 billion. By March of 2020, that fell to a low of about $125 billion. But it reached a peak of over $3 trillion in November of last year. Assets have peaked at enormous levels, fueled by the historically cheap money. But what happens when this party comes to an end? What happens when the Fed stops the stimulus? What happens when the Fed is forced to raise interest rates? So, to begin, what about the Fed stimulus? Well, after March of 2020, the Fed began a program of quantitative easing, QE, when it began buying long-term bonds and mortgage-backed securities. The increased demand for bonds from the Fed boosts the price of these bonds, which lowers the yield. Combine this with banks having more money to lend out due to the historically low interest rates, it equaled investments in lower yielding bonds, giving way to investments in higher performing stocks and even crypto. Investors were chasing assets that could provide a yield. Well, this bond buying program from the Fed is about to end. Yes, the Fed is about to start tapering this down. The US Central Bank began tapering in November of 2021, scaling back total purchases by $15 billion a month, from $120 billion to $105 billion. And the Fed decided to double this pace at which it tapers on December 15th. Rather than $15 billion, the Fed would reduce purchases by $30 billion every month into next year. This tapering will continue at the high rate of $30 billion a month, or it could even ramp up more and increase until the bond buying program wraps up in late winter or early spring of this year. Now, tapering down bond purchases will have a ripple effect. The yield on them will increase as the Fed slows down. Stocks will begin to face stiffer competition from these bonds with increased yield. But that increased competition and yield won't be something to worry about until the Fed decides to raise interest rates. So when is that happening? Well, things have changed quite quickly regarding the Fed's stance on when they're going to raise rates. From this transcript of Federal Reserve Chairman Jerome Powell's speech given in early November, we can see he said this: "I do think it would be premature to raise rates today. I don't think that's controversial. Certainly, I don't know anyone arguing for today. And the reason is that there's still ground to cover to get maximum employment." So just a few months ago, raising rates was out of the question. Well, let's hear what Mr. Powell had to say just a month later, in the middle of December.
We're in a very, very different place with high inflation, strong growth, a really strong economy. That as I mentioned, the SEP medians are for 4% growth next year, 3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes.
A month later, Powell's tune changed. It's now appropriate to raise rates going into 2022. But when this year are rates planned to be raised? Well, Jerome spoke again in December, clarifying just this. Let's listen in.
Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Rates won't be raised until the taper is finished, and like I mentioned earlier, that is coming sometime this year. But Jerome said 2 meetings away from completing the taper. What meetings? Well, he meant the FOMC, Federal Open Market Committee meetings. As we can see from the schedule of the meetings, we have one this week, starting tomorrow. And then the second one in the middle of March. So if things go according to the Fed's plan, rate hikes may be announced by March of this year. The question is, will they, and by doing so, pop the everything bubble? Well, the reason they just might is inflation. As we can see from this chart, anytime inflation has peaked above 5%, we have gone into a recession with the US economy. 1970, 75, the early 80s, 1990, 2008. Although here is what's so interesting. Pulling up the Fed's interest rate chart over time, each time one of these recessions came, in the gray, the Fed fought it by lowering interest rates. Inflation today is once again above 5%, actually sitting at 7.1% with the last drop of data, signaling a recession is about to come. Yet the Fed is talking about raising rates? Well, they can't without destroying the economy, popping the everything bubble, and forcing that recession or even depression. Now, have you seen assets and their reactions to the Fed's recent talks and moves? Since peaking at a record high January 4th, the S&P 500 lost 8.7% in just 17 days. Another fall of 1.3 percentage points would take the main US market index into correction territory, and a further fall of 10 percentage points would take the index fund into a bear market, and thus a fully fledged stock market crash. And meanwhile, the pumped up NASDAQ has fallen by another 15.1% from its high, another 4.9 percentage point fall, and that tech index would also be in bear market and crashing territory. And of course, we know Bitcoin, it was down nearly 50% from its November peaks. These moves have come even without the announcement of rate hikes. The markets across the board are expecting an announcement from the Fed at the first FOMC meeting this week, an announcement of increased rates. The markets are already pricing it in. The more the Fed scares the markets into believing it will tighten, the bigger the market sell-off and the worse the economic slowdown. Incidentally, this also means the faster the markets crash, the faster the Fed panics and is forced to stabilize stocks, because if you didn't know, this year is an election year, midterms. A market crash can't happen or the Democrats will be destroyed in the midterms. Thus, in my opinion, the everything bubble isn't popping this year. The can will be kicked further down the road while inflation soars. But it will come by 2023, mark my words. Cheers, viewers. I'll see you next time.